and try to wrap this up in about 30 minutes and allow time for Q&A. So not a deep dive today, but we're definitely going to touch on some things I do think are important. Believe it or not, it wasn't the insurance guy that initiated this whole webinar, this whole concept. It was the attorney guy. So I'm really interested to hear how this is going to play out. So this will be fun. Like Carrie said, I'm Brent Couch. This is Kevin Reed. I believe we know pretty much everybody on the call today, but in case we don't, we're clearly Torch partners, very involved in the rural hospital community and marketplace in Texas, and excited to be here with you today, obviously. So I'll kick us off, and then Kevin and I will kind of go back and forth with some of our thoughts and feedback on these different issues. We thought we'd start by just stating the obvious, which is insurance, the challenge of keeping up with all the rules and regulations and the risk that comes with it is complex. And insurance hasn't been simple since forever. And I would love to bore you with stories about how insurance was invented in the 1600s, but I won't. Just know it's been around a long, long time, and it is forever getting more and more complex. And I will just add the comment that unfortunately, as you all know, as hospitals and hospital executives, the world of healthcare is complex enough. So when you add insurance into the mix, and really what insurance is intended to do, which is to manage and mitigate risk at every turn, that's where, of course, the legal issues, if you will, sort of come into play in all this. So they're all intertwined, very complex. We have both risk and compliance issues related to the type of insurance, just so you'll know what we're talking about today. Property and casualty is one term, a bucket, which includes property insurance, professional liability, general liability, D&O, which is the directors and the officers and everything to do with fiduciary and employment practices, all the way through workers' comp. And that is all in what we call the bucket of P&C. And then you have employee benefits, and that's all the health insurance and the things that you offer there. What I wanted you to know about all of that is there is some correlation, there is some overlap that you have to be thinking through when you're stepping back and looking at your total insurance program, how complex it sort of can be. Things like fiduciary liability or employee benefits liability, or even your workers' comp, they kind of bleed over into that employee benefits world. And so there's some things we're going to touch on there. And the last thing I'll say about complexity and what's going on, the challenge, unfortunately for all of us, and we're all affected, we're entering into what's called a hard market. And all that means is that insurance companies are being more restrictive in what they're willing to offer us, the consumers, and they're going to be more challenged to offer pricing and premiums that unfortunately are going to go up. And we're all going to experience that. Kevin was very astute into bringing a point to my attention, and that is that things that happen around the globe can actually happen and can affect us in places like Carrizo Springs, Texas, for example. So it's hard to believe, but what goes on in Australia or in Asia or in Russia actually can impact us at home. And cyber is an example, property is an example. And so I could talk a little bit more about that, but I was going to let Kevin chime in and see if he had any thoughts to share in this arena.
Sure. Well, let me just mention a couple of things. First, I think it's important for people to realize that, and Brent can expand on this, but insurance is a global market. And so, for example, when you buy coverage in Texas or in wherever you are in Texas, it's very possible that the carrier you bought coverage from bought reinsurance in London. And that London market is certainly affected by what happens all over the world. So your rates are directly dependent a lot of times on world events. And I think that's important to remember. A lot of times people will say to themselves, well, we haven't had a bad tornado in West Texas in forever, or we haven't had a hurricane in forever, so why are my property rates going up? Well, your property rates might be going up for a totally unrelated reason, like, for example, the fires in Australia. The other thing I want to, as we start out this discussion, I think it's important to talk about, and this is the reason really why I wanted to have this discussion to begin with, is Brant, Barry, I have an opportunity to go to a lot of board meetings, and we see the insurance discussion often at board meetings. And I can tell you that many times the insurance discussion at board meetings is, well, we have this option, and that one's less expensive, so that's the obvious choice. That is the wrong way to have a discussion about insurance. And on the legal side, we end up seeing that the impact of that later on. And the reason I say that is that later on it may turn out that because the cheaper choice was picked, those two things weren't apples and apples, and so your coverage may be less in the cheaper choice, for example, or your coverage may be non-existent in the cheaper choice, or the claims handling might be substantially more challenging in the cheaper choice. And so I think it's really important in any kind of an insurance discussion, and this is one of the things I hope we get across today, is there's good questions to be asked. And these are the kinds, we're going to talk to you a little bit about what kinds of things to ask. Now, sometimes, and hopefully more than often not, the less expensive may be the best policy to buy. But you need to make sure that you're comparing apples to apples and you understand that it is when you do that. So,
yeah,
back to you.
Yeah, no, great points. And so I think that's where we wanted a good launching pad here is, what are the best practices that we can share, the questions you should be asking, the type of advisors you should be using, et cetera. We have 4 key elements here for best practices, and they're not on the slide. I'm just going to tell you what they are. One is gaps and overlaps reviews. It's a continuous process that goes both ways. Your attorney's involved, your broker's involved, and you as the executives and management team are involved. And then ultimately your board needs to be clued in as to what you are looking for with any gaps or overlaps. That's number 1. Number 2, seek hospital expertise. We'll talk about this. Now, this may sound a little self-serving and obvious for us because this is what we specialize in, but there are other brokers and attorneys out there that have hospital experience. Whoever you choose to work with, you've got to make sure you're using the right advisors to help you navigate these complexities. The third is engage the board. Kevin said it best. We always use the term around here, no surprises in the boardroom. That makes for a bad day. So we want to make sure you engage the board, and then finally communicate constantly with your advisors. So it's not just them telling you what to do, it's you telling them, hey, we decided to employ a doctor this week or last month or last year, and we're just now telling you. So we need to make sure that communication is key. So we're going to launch into the first one, which is gaps and overlaps. Again, not a lot of slides, just comments and points here we want to convey. And so I'm going to read through kind of a laundry list, if you will, of things that Kevin and I came up with that we find that hospitals tend to not do or they can fail at doing. And so I'm going to start with that list, and then Kevin and I are going to kind of bounce around and talk about those. So number 1 is adjusting your coverage to meet the changes in your operations. So we see a lot of hospitals that just rock along buying the same thing, the same coverage, never asking question, and they're entering into nursing home UPL arrangements, they're employing doctors, they're buying property, and they never convey that information. Understanding what's not covered in a policy, that's number 2, that's exclusions. Periodically shopping the coverage and knowing the difference. Understanding panel counsel requirements. And then understanding coverage and the deductibles, how the deductibles work, and then finally claims handling. And so I'm going to kind of go back to some of these, and we're going to use, I think, a couple examples of things like property insurance, management liability, and cyber. But why don't we talk with adjusting coverage to meet changes in operations? And let's talk about property insurance. Kevin, you mentioned one of the things you see a lot are business interruption, people not thinking and talking to their boards about it, understanding what it does, why they should do it, and then just adequate property insurance in general.
Yeah,
what do you see?
I'll give you the best example of that because this has happened within the last 30 days. One of my clients bought a home adjacent to the hospital, and the purpose of it was to use it as a physician office, and they renovated it, and the physician moved into it. And a week later, they had a major storm that took the roof off. And gosh, they forgot to add it in the policy.
Mm-hmm.
And that's one of those things that, it just is a hard situation. But that goes back to your comment about making sure to adjust coverage to make changes in the operations. You have to be constantly thinking about, are we covered on this? And it can be, like you said, it can be another doctor we hired, it can be another piece of property, it could be some change in our cyber exposure. Have we got this under the coverage?
Yeah. I think that the other thing that business interruption. So this one, I don't think it's at least for the clients we work with, it's not as confusing anymore, but I still do run into it. And that is, how do we know what the adequate amount of business interruption, and should we be buying business interruption? I think the greatest story there is what we've seen over the last couple of years with the major wind and hailstorms, or anything that would cause a hospital to have to shut down operations, even for a few days. That the calculation, when we sit down and do a calculation with the hospital, how much revenue you make in a day, and you back into that, and then you determine what your deductible looks like, which is what's called a time element, and we start pointing that out to hospitals, that's when they really start to pay attention. That's when they start to go, oh, because there's some policies that we run into out there, not typically the ones we would recommend, where they offer a flat limit, like $1 million of business interruption. When you actually go through a business interruption worksheet, you look at ordinary payroll, you look at revenue, you back out bad debt, you back out certain things, someone's got to go through and do that calculation. Occasionally, not often, we see people just, hey, here's a number, we just sort of made it up, pulled it out of thin air, how does that sound? The other way to go the wrong direction there is to try to account for every penny of revenue for maybe even a full year. So now the number's $33 million, and that adds to your premium. So there's a happy medium there. I don't know if you have any thoughts on that, Kevin. But
I guess the only thing, and tell me what you found, but my experience with business interruption is it's usually very cost effective. In other words, it isn't highly expensive. It isn't like property is right now. It's not highly expensive coverage, and so it just makes sense to me.
Yeah, those are the big ones, I think, in the realm of property insurance. Lastly, it's going to be a challenge for all of us, is that deductibles are going up, and deductibles are getting higher and higher for all of us, and that's going to be just an issue that we contend with. So there are techniques and tactics. You need to have your advisor talking to you about what those are. One example is a property form where the limit for the hospital or each individual building can be sort of carved out, and the percent deductibles applied to that building only, as opposed to the whole total insurance. So if you apply a 3% deductible to 30 million versus 3 million, that changes your deductible pretty significantly. So that's an example that we see out there a lot. Let's talk about management liability. This is where we start to really get into the business of the board. Kevin, you mentioned fiduciary duty coverage. We call that fiduciary liability coverage. You had an example. This is an inexpensive coverage that doesn't get talked about very much, but maybe you could comment first, and I'll give my opinion.
I would say where the first time I ever ran into this was where the hospital had used a local broker to assist with respect to its 401k. And the local broker had placed the 401k management with a relatively small firm. The firm actually was headquartered at the time out of Nashville, but actually managed lots of other 401ks. The guy who ran the 401k was a fraud, basically absconded with all of the money, so every employee who was a participant in the 401k lost everything. And you had people who had been in the 401k for 25 years, and that was their retirement. So it was a devastating experience for the employees. Through a number of efforts, we were able to recover virtually all of that, but it took several years and lots of litigation to do that. And also the fact that they had fiduciary coverage, which was tremendously helpful in the pursuit of of that case. But without fiduciary coverage, you may have had a situation where, again, you lost the employee's 401k, and then actually you expose yourself to litigation in that circumstance by not taking the steps that you should have done to make sure that money was properly protected. I mean, that's really what fiduciary coverage does in the most plain circumstance.
Now, this guy didn't have the first name Bernie or the last name Madoff, did he?
He did not, but he was equally an equal scoundrel, I would say.
Got it. Scoundrel coverage. That's good.
I will say that the millions of dollars worth of art that he had bought with a lot of the money was auctioned off at a substantially reduced prices.
Gotcha. Well, that, fiduciary coverage is intended to cover the hospital for errors and omissions in managing any type of benefit plan. That could be your health insurance or your pension, 401k, any type of retirement plan. And that includes making possibly poor decisions in the advisors you choose, right? So that's exactly what that is there for.
Let me mention one other thing, because I think it's important, because this is the most common question I get when we talk about gaps. And that is that people get involved in a suit over a breach of contract, and the first thing they do is they call you and they want you to call their insurance carrier because they want coverage. And it's important for people to realize that in a run-of-the-mill contract dispute, you are virtually going to never have coverage in a run-of-the-mill contract dispute. There's simply, and Brent, add to this if you want, but there's just simply no coverage available for that kind of business disagreement.
Yeah, we get that same question all the time. What's the most confusing is if you're in a situation where there's what we call a D&O, or directors and officers liability. That's the policy you typically look for those scenarios. And it depends on how the lawsuit and what is being claimed, because sometimes it could be breach of contract, wrongful termination, discrimination, and three other, a whole litany of things that they're bringing to the table. This really does get into the complexity of what does the policy cover and what does the policy not cover. And, it can cover, and the insurance company's on the hook to defend and work this out. But ultimately, coverage can get thrown out if for certain elements of what's being brought against the hospital.
Sure. I was just going to tell you that we have probably about 10 minutes left, so we're a little bit behind on the slides, so we want to move on.
Absolutely. Let's move on then. Good point. Seek expertise.
Well, I was going to say one other thing before we do that, and I think it's important to know when we talk about gaps and overlaps, and again, asking the right questions for a number of policies, and the two that come to mind are D&O and cyber. There's a requirement that you use panel counsel. And oftentimes, not always, but sometimes. So I think it's important to know that a lot of times what they do is they give you a list of who those counsel are, and you are required to use those. And I will tell you, in some cases, that's okay, because in some cases, those are very good firms. In some cases, it can be a little panel counsel requirements can be a little challenging because you end up with somebody who this is difficult to say, but I think sometimes you end up with somebody who has a closer relationship with the insurance company than they do with you, and that can be a little bit challenging. And sometimes you can't get away from panel counsel, but it's important to at least know that it's part of the policy.
And I would add to that, one of the things that you want your broker or advisor doing is making sure they understand who you, the hospital, want to use as your counsel, and then going to those insurance companies and working out, if it's possible, to get that law firm on panel, which is what we do. Now, some law firms refuse to be on panel, and that usually is telling when it comes to their rates and their fees.
Yeah.
So
one other thing just to mention before we go on this, and this is this idea of whether one of the things I said at the beginning is whether coverage is apples and oranges. And I think this is a really important issue in the apples and oranges. Some policies, the policy expenses are paid within the limits of the policy, and some are outside. The defense costs, for example, are outside the limits of the policy. So in other words, In some cases, if you have $1 million of insurance, your attorney's fees are not, or the expenses are not eating away that $1 million. So throughout the whole piece of litigation, you'll still always have $1 million to pay at the end. In some policies, that's not the case. They're paid out of the same bucket. And so the higher your insurance, or the higher your defense costs are, the less you'll have to pay. And I'll give you an example of that. Is I had a case, a hospital case, a very nasty case. Was a physician got mad at the hospital, sued all the board members, sued other members of the medical staff. It was a difficult, long, nasty case. And the hospital did not want to settle the case. They had, and actually this was a case with panel counsel. And so the panel counsel happened to be a very big, national, very expensive firm. And about 2 years into they had $1 million policy. About 2 years into the case, they had $900,000 in attorney's fees. And so they were down to only having, if they went to trial in the case, they were down to only having $100,000 in coverage left if they tried the case. So ultimately, they settled the case that they didn't want to settle, but they settled it because it was the best thing to do under the circumstance, because they didn't have much coverage left. And if they continued to go on, if they'd actually gone to trial, they'd eaten up the coverage completely. So if they lost at trial, they wouldn't have had any coverage at all in the case. So when you look at apples and oranges, it's important to understand that.
Well, I think that's a good segue into talking about this seek expertise. That was one of the best practices. So let's jump to ask the right questions. One of the questions we get the most is, how much coverage should I carry? What is the appropriate amount of D&O coverage? What's the appropriate amount of cyber coverage? Unfortunately, the initial answer to that is it depends. But let's give you some rules of thumb to think about what it depends on. So the point Kevin just made is, if you have your defense inside your limit, meaning you have $1 million policy that's only going to pay $1 million in indemnity and defense, which for D&O policies is not unusual. There's other policies like professional liability policies where that is unusual. So you have to understand the difference. So then you have to think about, is $1 million enough? Is $1 million enough protection for my board? One of the things that we always tell our clients to think about is, look at the makeup of your board. You probably have some board members that have some wealth that they've created. Maybe they're upstanding citizens in the community, and you start looking at all of them in totality, and you ask yourself, is $1 million really enough? Is it really enough to protect and indemnify this board of directors? That's one thing I would definitely say is the right question you should be asking when you're buying that coverage. I don't know if, Kevin, you agree with that.
Yeah, I absolutely do. Although I do think there's two sides to that. And the other side is, how deep a pocket do you want to be? And there is a sweet spot, I guess is the best way to say that. And that sweet spot is, at what point have I adequately covered my board and my organization without unnecessarily exposing them because I made myself too wonderful of a target from a plaintiff's lawyer. You know, one of the things that we run into, and you probably have seen this occasionally, is we'll run into a hospital that has $5 million in coverage and a $20 million umbrella or something like that. Oh my gosh, that's just like a dream for a plaintiff's lawyer. I mean, if you find somebody who you think has the potential of $25 million in coverage, that's just a joy.
Right. Well, luckily we don't see too many of those in the type of hospitals we deal with. But yeah, I think, I guess if I had to just throw some numbers around, I'm seeing D&O policies and cyber policies creep up from 1 million to 2. I see some facilities going as high as, say, call it 3. You rarely see a rural hospital district type facility going much higher than that when it comes to things like D&O and cyber. Obviously, on professional liability, if you're a hospital district, you have the protection of the law, so that occurrence limit is still down where it is. So those are some of the common limits I see. I see you nodding your head, Kevin. That's pretty common to what you're.
Absolutely, and we're seeing people raise their cyber coverage because of the remediation costs in cyber.
Yeah,
and everybody's finding that the remediation costs in cyber are very high, and so that's pushing the coverage higher.
So these rules of thumb, we're diving into that now. We just talked about limits on how to kind of gauge that. Price versus cost. I wanted just to touch on this by saying the premium itself, as Kevin talked about, is one thing. But if that premium gets you an insurance company that's not experienced in managing claims, that doesn't have the right coverage structured in it, you may be paying the lower price for a piece of paper that's not worth the paper it's written on. So that price versus cost, what it's going to cost you in the long run versus that premium up front, that's the analysis there. Picking carriers that actually work in the hospital realm. I've come across this still to this day. We'll have a hospital that maybe was using a local agent for the D&O, and we'll see some insurance company. This happened a few years ago. We had a hospital go, hey, the county handles our D&O for us because we're part of the county. Great. Have you looked at the policy in a while? No, we trust them that they're handling it. But why don't we take a peek at the policy? Turn to page 3. There was an exclusion section that excluded two things. It excluded airports, which is good, and it excluded hospitals, which was bad. So there's really simple things just by looking at the policy to make sure that you've got the right carrier with the right coverage. And that kind of exclusion, that's the drastic example. I don't know if you have other examples in any one of these bullet points here, Kevin, that you wanted to share.
Now, I guess the only thing I would add on this is also the reason to rely on somebody who's whether it's HealthSure or somebody else who's a known hospital broker to help you in this, because there are some carriers out there that frankly just do not do a very good job when you need them most. When you need them most is when you have a claim. And I will say that a good broker never wants to sell a policy like that, because a good broker doesn't want the flack from his client about why did you sell me that when I've had nothing but trouble with it when I had a claim. And right. So to me, a good broker understands the coverage, both understands the coverage, but also understands the carrier, and understands this is a carrier that has worked well with my clients, that I've had good responses from in my clients, and they're the kind of people that I want you to be able to do business with.
Yep. Yeah. This last one, clarity, just a quick note. If you're filling out that insurance application or you're delegating that to an assistant or someone to fill out, review it, have your agent review it with you, ask for help. If you don't understand something on an insurance application, ask your agent, please explain this to me, because that's where it all begins. So we want to make sure that you're getting that. Okay, let's move into the home stretch here. We'll kind of get through the last two best practices. Engage the board. Kevin, I'll let you start here. Any big takeaways for engaging the board? What you mean by that?
Well, again, I think the most important thing is, typically your coverage is approved by the board. And so it's important that the board understand what they're buying. This is one of those circumstances where one of the things that I often see is when there's not coverage or the coverage is inadequate, the board will immediately say, well, why didn't you tell us that? Why didn't we know that? And so it's important that the board first of all understand what questions to ask, that the board understand the coverage, and in a way it's a kind of a cover yourself situation. But yeah. It's really this is sort of risk management 101, that it's important that they be involved in the decision making and understand the decision they're making.
I totally agree. And I think it's that no surprises in the boardroom. I mean, we can't avoid every single surprise out there, but you can really ask the right questions up front. The biggest thing we've noticed lately is what we call this coordination of coverage. And this is where I've got a regulatory billing E&O policy, I've got a D&O policy, I've got a cyber policy. They all have some HIPAA coverage in there. Has somebody gone to the effort to inform each of the insurance companies who's going to act as primary and who's going to act as excess, so we don't have three different insurance companies all pointing the finger at each other? That's what I call the coordination of coverage. That can be a really big deal if it's not managed. It's why I really get nervous when a hospital says, well, I want you just to handle this policy, and then I'm going to have this agent handle that policy, and then I'm going to have I'm going to buy direct from the insurance company for this policy over here, and never shall the three talk or meet. And so that makes me nervous, especially at the board level.
Yeah, that certainly makes sense. I also think that here, out-of-pocket expenses are really important, because that's another one of those things that boards are the key in on, I think. And again, if you have in some cases you may want $100,000 deductible, but you can know that when the board's out $100,000, they're going to say, well, how did that happen to us? Why did we have that? Why did they have that deductible? And you want to be in a position of coming back and saying, well, you had that option and you chose that deductible. That was the business decision you made at the time.
Yeah, absolutely. There is even a way in some policies to coordinate some primary and excess coverage to reduce your deductible, to line those up so that you're not actually paying two deductibles before coverage ever kicks in. And so that's also coordination of coverage, but that's a better way to say that. It's coordination of deductible. That really needs to be talked about with your agent when you're putting these policies into place. Okay, so the last best practice is communicate constantly. And so I wanted to personally make sure that, yes, you need to have advisors, your law firm, your agent, the people that are going to help you navigate some of this, bringing things to your attention, but it goes both ways. You need to let your advisors know, hey, I just employed a doctor. Hey, we got a complaint from the EEOC and we didn't think much of it because it's not actually a lawsuit. So we're just going to file it in the drawer and worry about that later. And then now, lawsuit comes 9 months later. You never notified your insurance company. So now you've missed that window of timely reporting to the insurance company, and now you have no coverage. That kind of communication breaks my heart because you had the coverage. You just never reported the incident to us or to the carrier. And so you missed the opportunity to ever have that coverage payout. So that's my biggest takeaway for please communicate. Kevin, how about you?
First of all, I agree with that completely. I think the thing I would do is touch on, I think there's a lot of risk management things that can be done that potentially reduce your exposure. And I think the more communication that you have, for example, with your broker or with counsel or even people from the carrier itself, a lot of these carriers provide really significant resources, educational resources to reduce risk. And if you use those resources from the carriers to help reduce risk, a lot of that can be really very helpful. And I'll give you an example of that because this relates directly to cyber. Because we had a case within the last year to 6 months, and one of the problems that we found in the case was that the hospital did not have a limit on email inboxes, outboxes. There was no requirement to delete their deleted files, and so we had a phishing problem. Now they were able to limit the phishing intrusion into a single box. But the problem was that the person who opened the phishing, literally had 70,000 emails between all of their various boxes because they've been at the hospital a long time and they were one of these kind of never delete people. And so the remediation cost of that was absolutely enormous because of that. You probably are aware from a risk management standpoint, there's a lot of organizations that don't allow that have box limits. And part of the reason for doing that is to limit your exposure for what's out there and available. And I hate to see in this circumstance, had that phishing gotten into other boxes beyond this, we would have exceeded the policy limits on the remediation costs.
Yeah.
And so it's little things like that you can learn from. And learn kind of what best practices are, how best to do it, and why it's important.
Yeah. And sometimes it's the insurance world, especially cyber, is getting tighter and more restrictive and more expensive because of those ransomware attacks and things like those phishing expeditions, if you will, and those phishing cases. The policy is often what's called sublimited. So you may have $1 million cyber policy, but you only have $100,000 sublimit for phishing or cybercrime. Now, the agent, even us, in some cases may not be able to get a higher limit than that. But you definitely want your board and your IT people and everybody to understand it's not just a catch-all policy that's going to pay for everything that happens. It's education.
That's a good point. And I'm glad you mentioned ransomware, because before we let everybody go, I think this is also a really important point to make. There's a lot of concern that the ransomware world is shifting. And by shifting, I mean getting more expensive. I'll give you the best example of that. Many of you read about the Colonial Pipeline case. The Colonial Pipeline case is why we have had this potential gas shortage over the last 60 days. What happened was there was a Colonial Pipeline is a major gas line. They had a ransomware attack that shut down that pipeline, actually shut it down for a good period of time. And shutting it down basically upset the refinery capacity in the country. But Colonial Pipeline paid $4.4 million in a ransomware attack. They pay it in Bitcoin, so it's never traceable. So the people who got the $4.4 million just are able to walk away with it. And the chances of ever locating them are pretty slim when you make payments in Bitcoin. But the interesting thing about that is historically, ransomware has been relatively modest amounts, anywhere from probably 10 to 40, sometimes $50,000. And the reason for that is that you want incentive for people to pay it, and pay it. The element, the kidnapper, I guess I'd say, wants an incentive to get that money and to get it relatively quickly. And so if you kept the amount low, you were more generally able to get paid and get paid quickly. And one of the reasons for that is that people would take into consideration what my correction costs are. And if you thought to yourself, well, it's going to take me $30,000 to fix it, I might as well pay them the $30,000 so I can get the thing back. And so we had those low amounts. Well, the Colonial Pipeline case was totally different, and we're seeing a few more of those. And if we start to see $1 million ransomware cases, that's a change in the world. And also remember, healthcare is very vulnerable to ransomware. I mean, our systems continue to be not as sophisticated as banking systems are, for example. And I mean, healthcare is still generally seen as an easy target in the cyber side, and so there's some high risk stuff out there.
Yeah, we are going to see massive shifts in the cyber liability insurance space, and they're happening before our eyes right now.
So I just noticed that we had a good question, and that is that this has to do with limits on email boxes, and how does that coordinate with the Public Information Act? Well, I would say the best way to deal with that is you should still have limits on, for example, you should have limits on your inbox, but that doesn't mean you can't archive. And so, for example, if you have limits on your inbox, you archive everything up, certainly up to the limit. And I will tell you that I'm an email saver, so this is one of those things that impacts me. But people that have 10 and 20,000 emails in their inbox, and that's not an unusual thing. That is a high risk situation from a cyber standpoint. So there are many organizations that have very, very tight limits on particularly on your inbox. And they still move off and save stuff into an archive, so that stuff is not available to a hacker, for example, but it again limits your liability. And when you limit the inbox, I mean, typically what happens is that you basically have a shutoff, and if a person reaches the shutoff, they're not getting email. I mean, your email is basically just shut down until you clean your box, and it's it causes a lot of employee pushback, but it's a huge risk management issue. And I encourage people to take that step, because there's too much risk on big boxes. I'll tell you another thing, just as one of the big hospital chains, one of the big national hospital chains actually has a rule that if you open more than 3, they give you 3 options, 3 kind of chances. But if you open more than 3 phishing problems wrongly, you're fired. And the reason for that is that from a risk management standpoint, they do a lot of training, and if you can't learn not to open suspected emails, then you're too much of a danger to their entire system. And so that's just a very kind of clear employment standard. You're either careful or you're not, and if you're not, you're fired.
That's a scary proposition when we already have staff shortages as it is for people. So yeah, you don't want to be that person that 3 strikes and you're out. Really good points. So, Carrie, we're kind of already into responding to chat questions. So, any other questions from the audience? And we can start to wrap up if not.
There's been no online questions, so if anybody has any questions, you guys can unmute your lines and ask Kevin and Brent directly.
This is John Graves. I just want to say thanks for taking the time today. It's very important, and we need to better understand what our options are. So thank you very much.
Yeah, I thought it was wonderful, guys.
Thank you, John. And if people have questions afterward, I'm sure either Carrie can send them on to us, or Brant or I will be happy to answer anything if you want to email us afterward.
Yeah, our emails are on the screen right now in case anybody doesn't have that. We're always here to answer questions. It's complex and it's getting complexer, but there's hope. If you just communicate, follow those best practices, engage your board, constantly reviewing. I think those are going to be really a good prescription for sort of staying ahead of the complexity curve. So unless there's no more questions, let's see. I'll see a chat coming in now.
It's
Complexer. Yeah. Mm-hmm.
Harassing you.
Yeah, that's strategery. The word complexer comes from strategery. Well, Kevin, thanks so much for putting this together. I appreciate the time.
Carrie, thank you, and thanks to everybody at Torch.
Appreciate it, guys. Y'all take care. Bye-bye.
Bye-bye.